Ron, thank you for coming back. Just for those who may not be familiar with you, what is your investment philosophy and how much do you now have under management?
The investment philosophy is to invest for the long term in businesses that have big growth opportunities, competitive advantages that make it difficult for other people to do what they're doing, that have businesses that are well managed. And when I'm talking about long term, the average holding that I have in my funds is about 6 or 7 years. So the average mutual fund turns over its portfolio every 6 or 7 months. Hedge funds are much shorter. Ours are 6 or 7 years, so it's unusual to invest in that way in a public mutual fund. And under management is about $17 billion, a little bit over that.
Now you've been expanding the number of funds you have. You fear you might lose sight of what made you successful all these years? Why so many new funds?
Well, we have, for example, a new real estate fund that we started 3 years ago, and that was at the bottom of the market in real estate. We're in the midst of a panic. And that fund this past year is up over 40%, 42 or 43%. And over the 3 years that it's been existing, it's up 70%. And last year, I think it might have been the #1 mutual fund in the country. And the reason we started in the first place was because we think about $1.5 billion of the assets that we manage have a real estate element that is important in the valuation of those businesses. And in this person who manages this fund, who's worked for us for 6 or 7 or 8 years, this is the idea they want to have a real estate fund. I didn't want to have a REIT fund. If I wanted to have a REIT fund, I would go invest with Cohen & Steers. Why would you do us? But I was interested in investing in real estate differently than other people invest in it, similar to what we invest in our other funds, and this has worked out very well for us. So it's a supplement to our existing business as well. It gives people who are working for us more responsibility. And now it so happens that fund is probably currently our best inflow money fund. Yesterday was $2.5 million into the fund. The day before was $1 million. So every day that fund is taking in nice assets now, and I'm very pleased with it. And of course, it's because of the performance of that fund. So we start these funds because we think there's a good opportunity for our clients, and we start them also because we have a background in what we're doing, and it gives people more responsibility and makes them better analysts and portfolio managers, to help us, and it gives our clients a good chance to make a lot of money.
Give a couple of examples, say from the real estate fund and also from your energy fund, where you pick companies a little differently than those who focus on those categories.
The energy fund is a fund that's it's not ready for prime time yet. So we had done very well with energy stocks, and I was convinced that we should do this, and we'll see if it works. That's not clear so far. And as far as the real estate fund, what's interesting about it is that it follows the path that all of our other funds follow, about how we invest. And it's the same thing, trying to find opportunities, competitive advantages, growth opportunities, competitive advantages, special managements. For example, if you are someone who's building office buildings and you're in Chicago, there's no competitive advantage that you have in your building over someone else who has another building, because it's all these rail yards. All you got to do is plenty of land. All you can do is build another building in one of those empty lots. And in New York City, if you're building a lot, buildings, how are you going to build in New York City? It takes years to get approvals. And to give you one example, one of the companies that we have an investment in is Alexander's. And Alexander's is the Bloomberg building and some shopping centers in New York, and it's Steve Roth and Mike Fascitelli, and it's also from Vornado and David Mandelbaum. And the idea that we had was we invested in this company quite a while ago, and this year the stock was trading recently at over $400 a share, and they paid out a $120 special dividend. We've had a lot of special dividends this year, and $120 special dividend that was paid in December. And that was also invested in for our real estate fund. And Jeff said to me, so Ron, do you know when you bought Alexander's? I said, well, I guess, I don't know, probably owned it 15, 20 years. And he said, well, actually, you started, and what'd you pay for it? And I said, I don't know, I think it's probably under 100. And he said, well, actually, you started in 1992 at $22 a share, and it's now 400. And here they're paying you a $120 dividend. And so the reason it was interesting in the first place is you had these great people running this business. And then in New York, they had the Alexander site, which you could see right from our office building. You know, it's 2 blocks away.
Right.
So what a great site that is. And Steve Roth, for a long time, looked at it and said, I don't know, I can't decide if I should do this. Should I put in the high-speed rail that goes to the airport or not? And so it was years. And it was just coming out of bankruptcy. And I said, well, this is very interesting. You have a really good guy running it. They have great sites. You have competitive advantage if you're in New York City. And you have these opportunities that, to make something special out of this business with these raw assets that other people can't duplicate. And it worked. And so here we have a business like that, or that's one thing, betting on something like that. Betting on Tom Pritzker from Hyatt Corporation. Very interesting. That here is someone who I've known his dad when I was starting in business. He was one of the first people to help me in the 1970s, Jay. And so I know his family for my whole career, virtually. And what's interesting about Hyatt Corporation right now is that you're buying this company for less than the physical value of the owned properties, which are all being renovated, and the stock is so cheap. It's 10 times where the industry is 12 or 13 or 14 times, 10 times. And so people are not so interested in it. But to me, what's really interesting is they've had a lot of rooms that are out of service because they're renovating them right now. And so this guy has chosen, I don't care about short-term earnings. I care, for Tommy, I care about making the properties suitable so that when times are better, that people are going to want to stay in these properties, stay in these rooms, and pay me higher rates. So he renovates his properties. But then what's really interesting is that's good. He's got an underrepresentation. He's got really fresh properties, and he's got underrepresentation in big cities in New York. It's interesting. But in addition to that, in China there happen to be 1 million hotel rooms, and there's 1.3 billion people. In the United States, there's 5 million hotel rooms, and there's 300 million people. In India, there's 160,000 hotel rooms. That's like in Orlando. And so what he's got is he's got this ability to go into these new markets like China and India with this iconic architecture, which comes from his dad's love of architecture, Pritzker Award. And he's going into these new markets where there's these tremendous opportunities, and where the Pritzker Award was given out this year in China, and the premier of China was there to help with the award, and it was above the fold in the newspaper. That was such an important thing. And they're doing it with other people's money. So he's paying key money, which he gets to expense, and if you're spending $100 million a year on keys to get into those markets, and you're growing your business very nicely, then you're going to get leases that are going to go for, 30 years, 40 years on new properties that are being built in China where they're under-hoteled. And you're going to make on that investment, so if you put up $100 million and you get to write it off, then you're only investing, say, $60 million, and you're going to be making $20 million or $30 million a year in that $100 million investment. But it's really 20 or 30 and a $60 million investment. So one of the concepts that I have is that we're looking for, in a very high-tax, slow-growth economy, I want to look in high-regulation economy, then I want to look for companies that are investing in themselves and getting to write off that investment, and with competitive advantage, and therefore are willing to penalize current earnings, and therefore their stocks are going to be lower than they ordinarily would, so their business can be much bigger in the future than it is today. That's what we're doing. So we invest for the long term in real estate, just like we do in every one of our other businesses.
Since the financial crisis, you've had a rough patch, and one of the things you've said in the past is when you have a discipline, you stick to it. Otherwise, you're just going to get whipsawed. What have you learned from the last 5 years? What have you said, what should I have done differently? What did I do right and what did I do wrong?
In the worst mistake I made So I made a couple. You make mistakes every day.
Right.
Or not big ones, but I mean, you do make. It's amazing that you're still making mistakes. I still make mistakes after all these years.
It's when you think you're infallible, you get in trouble.
Oh. So with Barron Partners Fund, that was in one of the top performing mutual funds in 2004. And so the fund then grew a great deal, went from several $100 million to $3 billion, $2.5–3 billion. And what I did is that it's a focused fund. And I went from having 20 or 25 stocks to try to make it less risky. I went to 60 stocks. And then when the market crashed, so I wasn't getting good enough performance with a diversified portfolio, wasn't following the strategy that the fund normally adhered to. And then when the market crashed and the stock and it went down, I sold at the bottom the worst, my best companies and made it into a safer portfolio. So it didn't rebound. So wrote it down, then it didn't rebound as much as it should have. So all of the funds that we manage are above where they were at the peak in 2007, 10%, 12%, and this fund is still down 3 or 4% from where it was in the peak in 2007. What I've done though is I've taken the number of stocks in that portfolio from 60 back down to 21 or 22 stocks again, so it's back to fighting form once more, and I really like the portfolio investments. And so one thing is that you don't do is you panic at the bottom and you act contrary. You try to think what the market's going to do and make macro judgments instead of trying to be focused on your businesses. So be focused on your businesses, number one, and try to keep the market out of what you're doing. What else did I do wrong? That's one of the biggest mistakes.
You're bullish today.
Yes.
Even though people can make the case Washington seems determined to bring the world to an end, Europe, Japan. So what makes you bullish on stocks, or do you think you pick companies that know how to navigate these troubled waters?
Well, you pick companies that you think are going to navigate the troubled waters, for sure. But I think that the idea that we have, is that over the long term, stocks provide the best rate of return. And the reason stock market, of all the different asset classes, of bonds or real estate or commodities, and stocks have been the best over the long term. And the reason stocks have done so poorly in the past 13 years is because in 1999, they were 30 or 33 times earnings. And 32 or 33 times earnings was historically high in this country. So normally it's 10 to 20 times earnings, and the median is 15.5, and then it was 32. And the reason they've done poorly in the past 13 years is earnings have gone up 2.5 times, but the multiple is down from 32 to 13. So now it's below the norm of the past 150 years. So it's now 13 instead of 15.5. And business prospects seem fine. And the headwinds that we have are the fiscal, drawing back of stimulus and higher taxes, which is unusual for trying to recover from a recession. And if this works, then the Democrats are going to get reelected again in 4 years. And if it doesn't work, then what's going to happen is that if the Republicans can put up a candidate who doesn't have, odd social policies that are alienating very large percentages of the population, then you'll probably have a Republican as the candidate. But if they keep putting up candidates who want to offend blacks because they don't want them, they want to put up barriers so they can't vote, or women for taking away their freedoms, or Hispanics by saying that they should self-deport. I mean, just one thing after another. They tried to alienate all these different segments, thinking that they could just rely on white guys. And they lost women, I think, by 36 points. So if they come up with a reasonable candidate and they have a pro-growth agenda, I think the Republicans will win next time.
So that's your long-term view.
Well, or that the Democrats may be
Learning.
and maybe they'll be successful in the policies they'll put forth, and most people would have been happy to pay a little bit more in taxes to avoid the crisis we're going through. But so far, all we seem to be getting are higher taxes and no cuts in spending, which is puzzling.
Now, you've written in the past on companies like Ralph Lauren, Under Armour, and others that have, were once small and then grew to be big. What are some of the smaller ones that excite you today, the future Laurens of tomorrow?
Well, we have one of my favorite investments right now is a company called ITC Holdings.
Mm-hmm.
And ITC is a company that is the leading electricity transmission company in the country. And what they do is that the government has decided that in order to be more efficient in the provision of, use less energy, that what we should be doing is that we should be more efficient in transporting that energy. And electricity companies have underinvested in transmission because they make 65% of their money from generation. Right. So it's not really in their interest to invest in transmission because that means they would need to have less generation. So the government said, okay, we'll give you a different capital structure, a different return on equity. So our guy is the only one that's independently owned, and he was spun out from Detroit Edison. Henry Kravis bought it, and spun out from Detroit Edison when they gave this new regulations that were implemented, and our guy has run this company. And we've been the largest shareholder in it for about 5 or 6 years since it's been public. And we've made about triple so far. And I think in the next 10 years, we can make 6 or 8 times more. And I think we got at least 2 more doubles. And if they change their corporate structure after 10 years, then we can get another double. And the reason for it is that when we first invested in the company, when they were owned by Detroit Edison, they were spending $100 million a year on 15,000 miles of wire. And $100 million a year was enough to make them the worst electricity transmission company in the country. And when it was spun out, they began to spend $500 million a year, which is where they're earning this new higher rate of return. And they will soon earn, and they're now spending $800 million a year. Entergy, which is an equivalent size company, also owned 15,000 miles of wire. They're about to spin out their transmission business. And when they spin that company out, it's going to be combined with our company, so it'll be twice as big. So we got 15 to 17% of growth assured for the next 3 or 4 or 5 years without the combination with Entergy. If we combine it with that, then it looks like we got 15 to 17% growth for probably 10 years. And Entergy also is spending $100 million a year. So I think that here's a business that is providing, is solving a problem and is extraordinarily well run. The barriers to doing what they're doing are enormous. So I'm very confident that that's going to be a very interesting business. I would mention to before about Hyatt Corporation. Mm-hmm. I think that's very interesting. You know what happens? We keep getting these companies that Ameristar is a provider of, it's a regional gaming company. And there's so many businesses in which we've invested in the past year that have been acquired. So Pizza's one, Ameristar, there's just an offer that was just made for that one. Cymer, another one, makes chips that are faster, and they make the lasers that make the chips. And it's a recurring revenue stream business. And we thought that they were spending $4 a share in R&D and only reporting $1 a share, so the stock looked expensive when it was selling at $50 a share. But what we thought, $50 for $1 of earnings, but that was after $4 of capital spend, of expensing
right.
for R&D. And so we thought that when this new generation of equipment came on stream, instead of making $5 a share, they make $15 or $20 a share. And one of the things I was most concerned about was would I really get to have an investment in this business at $50 a share that had an unusual technology that was going to be giving us the opportunity to make $15 or $20 a share, and we sell $200 a share? And what happened is ASML was their biggest customer said, we're not going to give that opportunity, we're going to take it. And so they bought it from us at 90. So we're seeing activity.
Do you have a handful of other examples?
Well, another one.
What the investor appetite?
For, well, that was one this year. AmeriGroup was another one, which was a healthcare business. And that was one that we invested in. This is really interesting. We invested in this one probably 8 or 9 years ago. And it was a company that was a Medicaid provider and Medicaid insurer. And what they would do is they would go into a state and they would reduce the cost of Medicare by Medicaid rather by 15%, and then instead of growing 7 or 8% a year, grow 3 or 4% a year, 5% a year. And they would do it by providing services to the community that couldn't be provided by the government. And when we started, they were doing $1.3 billion in revenues, and they were $9 billion, and our cost was below 20. And now the stock, they just got acquired at $90 a share this past year, and it was trading at 60 just before the acquisition. So these companies that are just, the stock market's not expensive. When you look at, we had 4 acquisitions this year out of a portfolio of 95 for Barron Growth Fund. Genesee and Wyoming, this is short line railroads. So short line railroads, competitive advantage. They were built 100 years ago. And 100 years ago, they were able to get rights away. And when the company that built them was a manufacturing business, then all they were building them for was so they get their product to market, to New York City, to the big transcontinental railroads. And then what happened is that, so then it's impossible to build them anymore. You can't get the right-of-ways and they're too expensive to build. It costs $1 million a mile for track. And economically, you can't justify more than $200,000 a mile for track. So they can't be built. And what our guy does, Genesee and Wyoming, is he comes along and he buys them from the company that owns them. And he says, look, you guys are just using it to get your product to market. I'll give you just a very low cost to get your product to market, but I'm going to run it like a real railroad. I'm going to put other people's products on the railroad, so it'll transfer some of these costs to other people instead of just to you. And so this guy gets cash in his hands for selling his railroad. He gets the same cost of getting his product to market, and our guy gets to have a railroad that he's buying at a fraction of what it cost to build, but he couldn't build it anyway. And so I'm very excited about that. And then all of a sudden, a Carlyle group comes along, and they say, and our cost is for 3 million shares, our cost is probably maybe 3.5 million shares, our cost is below $20 a share. And probably 4 or 5 or 6 or 7 years ago. And Carlyle offers to buy $800 million at $58 a share, so they can buy the second biggest short line railroad, and that would be financing it. And they end up investing $300 million at 58, and the company finances the rest of it at 65, and it's now 80. That's only in the past few months. That just gives you an example of how cheap stocks are. One of my sons, Michael Barron, we're an investor in Carlyle Group, and he was meeting with Bill Conway. In fact, you had an article recently about David Rubenstein.
Yep.
And in that article, you talked about Bill Conway as being the best investor in the United States. And Bill was talking to Michael Barron, and he was telling him that it didn't really matter. He says he's never seen a successful investment, whether it's determined by whether he paid $900 million for a business or $1 billion or $1.1 billion. Didn't matter. It just matters about whether you have a really good business or not that is acquired. When we invested in Carlyle, that all the other alternative investment money managers that had gone public, every single one of them, you would have lost money. Whether it's Blackstone, whether it's KKR, whether it's Apollo, you would have lost money in every single one. And when I met David, I was very impressed with him, and then of course Bill, and then their chief operating guys. And when we invested in them, we looked at it differently than others. And the way we looked at it is that we just stripped it apart, broke it apart and said, okay, what is, and just realized we had a business that was raising enormous amounts of money to be invested. And what was interesting is that if you look at the business and consider that here they're getting fees from their accounts that they manage money for, which we sort of thought were similar to mutual fund management fees. And if you take those fees and give a 5 multiple to the revenues or a 10 or 12 multiple to the EBITDA, then we had the price of the stock. And then you got the book value and you got the carried interest for free. And if we said if the carried interest normalized was worth 6 or 7 times and the book value is the book value, then instead of having a stock that was worth 22 or 23, you had a stock worth 50. So you're buying something at a big discount to value, and these guys had an ability, their expertise is the ability to do business with the government that other people couldn't possibly obtain because they have all these government guys in this business and they have all these connections and they're able to help the government do better by doing business with them. So
what other alternative investments do you like right now?
Well, we like Oaktree is another one. Howard Marks, he's been on the board of Kerzner, which has not been a successful investment for us as a private company, but was a very successful investment for us as a public company. But he bought debt out of, when it had gone bankrupt, I think it was from either Merv Griffin or Donald Trump or one of those guys. And then it turned into Saul Kerzner took it over, and then Saul was so impressed with this guy, he asked him to remain on the board, and that's how I know him for a fairly long time, but not really well. But now he has a house nearby me in East Hampton, and that he's just built. And so now I'm seeing him more in New York. But when you meet him and you sit down and talk with him and listen to how he describes his business and how he thinks about people for whom, with whom he works and how he treats them and how he invests in businesses and the opportunities that he sees for those businesses, say, man, it doesn't take long after you meet someone like that to say, I want to invest with him. And it's like Tom Prisker. I was talking with him and on television, and in fact before that even, because he was describing to me about how when he invested in business, he said, there hasn't been a single plan that's ever been presented to him that worked as expected. Not one. And he said, on the other hand, I now have these 4 businesses or 5 businesses that are all worth multi-billions of dollars that have all been apart and aside from my Hyatt Corporation. There are, industrial businesses.
Right.
There are leasing companies. There are healthcare businesses. All of them, each worth multi-billions of dollars, and all of them where people who work for me say, you can't invest in that business. That's not going to work. It's not going to become something special. Don't fund it anymore. You're just throwing your money away. And he did, and he didn't. He continued to fund.
Right.
And he said, but the reason is that he bet on people. It was all this people thing. So he said, which is like his dad. When I used to go to Jay with an idea, the first thing he would do is he'd have this Rolodex. He'd spin it out, and then he'd say, when I was interested in a business, and I would tell him about a business, he'd call the guy in the town which the business was operated in and said, what do you think about this guy? What do you think about just get him out of the board meeting. That's how he would make his first cut. But he would have this great confidence in being able to rely upon his understanding of balance sheets and understanding of people to be able to do this. But it was the same thing Tommy says, if I had known how simple it was just really betting on these people who were taking these businesses and making them into something, he said, it would have been much easier for me a long time ago. But Under Armour is the same thing. When you talk to the people in Under Armour and you see that here's a guy, it's so improbable that he could be successful, and yet he built a business from nothing to $1 billion in sales in 17 years, and then in 3 years from $1 billion to $3 billion almost, next year, and then on the way to something really big if you can compete against Nike, where Nike is doing 800 million shoes a year, he's doing 8. And he's using the fabric that he's developing for garments, he's taking that into shoes and making a design shoe that's going to be much more suitable for athletes than the shoes that are used before. Everything else is the same. So you're going to have 10 shoes that are all the same, and all the sales that take place in Nikes or 1 or 2 other brands are smaller, but now he thinks that he's going to have one row of shoes that's totally different than all the others and technologically superior, and you think that's going to be a big opportunity for him, plus women's, plus the internet.
One final question. You mentioned how at the beginning stocks are it in terms of long-term value creation. When does this bond bubble burst? I mean, how long can it go on?
You know, I look at these charts all the time that show, Bridgewater has these great charts that show what long-term interest rates are, and they're 2%, and then they go up to 20%, then they go back to 2% again. And I don't think that what's happening now is so out of the norm of what's happened historically. And all the government is showing you is that the value of your money is just to transact. It's not to try to keep any value, not store value. And so the only thing that store value are things that can keep pace with inflation. In bonds, they're just going to, take your money away from you. It's just, sooner or later. They get you sooner or later. So it's like 1940 to 1947, when we had the same kind of debt to GDP that we do now. Of course, then we sort of had a way of getting out of it. Now I don't really understand how that's going to happen. But
neither do they.
Yeah, but 70% inflation, and takes money away from people. So I think that savings in dollars is a tough road to hoe, and businesses and stocks, that's the place. And as far as fixed income, then you know that the dollars you're getting back are going to be worth way less than the dollars that you're giving. So all these people I know are borrowing money at very low cost for very long times, even schools, everyone. As many people as can borrow, and people don't have any way to get 3 or 4 or 5% interest for a long time, so they want to lend it to you. It's something. How long does it last? I don't know, until the economy starts getting better. And if you just keep putting all these headwinds into it, maybe the economy doesn't get better for a while. But if you keep investing in businesses that have a chance to invest in themselves and make high rates of return, like I was mentioning to you before, a Hyatt, or mentioned to you before, an ITC Holdings, those companies that, or Dick's Sporting Goods, that here they have half as many stores as they can have, and each time they open up a new store, they cost $10 million, $2 million, they get $10 million in sales and make $2 million a year in profits in 3 years. So invest 2, get 10 million in sales, make 2 million in profits. Boy, you can do that a lot of different times, as long as, and they're interesting investments, as long as the new stores you open are doing as much business as the stores that you opened last year and the stores you opened the year before, because the retailer has to keep doing more sales in all your existing stores in order for you to have a viable business. Otherwise, your foundation is crumbling from within. So when you have something like that, that's interesting. When you have someone that you're just lending money to, that's never been so appealing to me. Unless you're lending money to someone like Howard Marks does, or like Mike Milken used to do, so they can take over their business when they fail to pay you back the money they owe you.
Ron, thank you very much.
Thank you very much.
Thank you for coming by.